Good morning to you all, and thanks for joining another episode of Coffee with Dan. This morning, I have a special guest to interview. Mr. Shehal Bartholomeus is a chartered financial analyst, and he's also the Chief Operating Officer and Head of Research of LOLC Capital One and LOLC Securities. I'm going to discuss with Shehal today interesting topic that has taken huge attention of the Sri Lankan public, mainly the stock market and the capital bonds. Good morning, Shehal.
Good morning, Dan.
Right. Let me ask you first of all, what does it mean by a share in a company?
Dan, basically, when you talk about a company share, it's basically ownership of a company. Let me give you a background of how you derive a share. Generally, when a company is formed, when you incorporate a company, you start issuing shares. Owners are the part of the shareholders. So when you issue the shares, the company share is a part ownership of the share. It's like a part of the pie of the company. So when you buy one share of, let's say if you have 100 shares, you have 1% ownership of that company. So when you tell about the share of a company, it's basically equity ownership of a company.
We know that a bond has become a very controversial issue in the country at the moment.
Yes.
What is a bond really?
Bond is different from shares. Now, both these instruments are investable instruments where investors look to gain return from investing in these two instruments. But the difference lies mainly in the ownership of the structure. Now, when you say it's a bond, it's basically you invest in a kind of a loan deposit. You get a constant interest rate income. But you will not get a ownership of that particular company. Companies now, there's basically two ways of companies raising capital to fund their operations. One is either going for bank borrowings or to raise equity. That is to give part of the ownership to the new investors and bring funds to the company. So bond comes in the earlier category I mentioned you. It's where you borrow some loans. So companies, what they do is they issue bonds and investors in turn put money to the bonds. So their agreement would be they will pay you a fixed interest rate. But in terms of shares, you don't pay a fixed interest rate. It's a sharing of profit. It can be way of the dividend payout, or it can be way of valuation increases of a share of the company as a whole.
We have heard the word stock market.
Yes.
What does this mean?
Stock market is where, now when I mentioned about shares, now for a normal layman person who can't invest in a private company. Like, so let's say you have a private bakery who wants to raise capital. But you can't ask for people to go and give you money. There's no regulatory framework. But what the stock market gives you the common marketplace. So in the stock exchange, you can get the companies to list in what we call is listing in the stock exchange. And when you list in the stock exchange, you are access to the pool of investors. So you have let's say 100 million worth of company. You invest in the list in the stock exchange, and the investors can buy part of that company. Then it gives you the opportunity for this company to access investors in general. And this because now investors investing in a unknown company per se, but now since now they are putting their hard-earned money, now it becomes very transparent. So it comes under regulatory framework of Security Exchange Commission, and Colombo Stock Exchange comes under the regulatory purview of SEC. So it's a regulated market and everything is transparent. So investors have that added confidence that they are putting money not to unknown entity but a known entity. So every quarterly that company will have to put financials out, and annually they will have to put a more detailed report. We call it annual report with the operation, in-depth operation, managing directors review. So the investors will know what they are getting into. So that's the main difference. Stock exchange is where the public investors can invest in the companies, equity companies.
We understand that not every company is listed in the stock exchange.
Correct.
How does this listing take place?
Well, there's a certain level of maturity you need to attain for a company to get listed in a stock market. Even in the world, there's a certain life cycle for a company. Now, when you start a company from a scratch, you are not in a position to get to the level of regulatory information out and provide all those paperwork. So it takes time for kind of a transition period is there for a company to come to the level of listing in the stock market. So once they list in the stock market, then you get the overall then you have the opportunity to the transition period. Coming back to your question, there's limitations for a company to get listed in stock market. Not every company can get listed because for example, in Sri Lanka, you need to there's two boards for a main board and Dirisavi board. For the Dirisavi board, you need to have minimum share capital of 100 million rupees. So in a small company, you don't have that kind of money in the initial phase. Why they have put such kind of cap is for have that liquidity for investability. For now, we are talking about thousands of investors. So let's say if you put a company which has about 10 million rupees capital, it does not serve the purpose. Investors can't invest in that company. So you need to have some level of capacity to absorb wide range of investors to the company. So that's why our regulatory system has put up kind of a floor levels for companies to come into the stock market. So then if you talk about main board, it's about 500 million floors likewise. So there's a kind of a transition and the life cycle of a company to advance it to a listed company, and it's kind of a prestigious this thing also for a entrepreneur in his life cycle. To get a company, he formed very difficult to across the hardships and everything and make it a public company. It's one of the challenge. And if a guy who can take it to the public level, then he opens up to a wide range of opportunities. Wide investors coming in, you can appoint wide board of directors, new technical expertise. You are basically pulling a company from a basic stage to a next level where you approach more advanced investors. You are into getting more industry in-depth knowledge. So it's a kind of a next stage of life cycle for a company to list in the stock market.
Which means that a small enterprise that starts in a very basic level,
yes,
can one day reach this status,
yes,
of being listed, isn't it?
Correct.
Now, Shehal, we know that in order to invest in the share market,
yes,
generally we need to go through a stockbroker or a stockbroking firm.
Correct.
Now, what does a stockbroking firm do?
A stockbroking firm is the facilitator for the investor to invest in the stock market. So again, it comes under the regulatory of having a proper mechanism to for the investors to meet their interest. So in Sri Lanka, in Colombo Stock Exchange has 28 such stockbroking firms. So our investor can invest in a publicly listed share which is traded in Colombo Stock Exchange is to open a CDS accounts and a stock through the broker. So only through the broker only you can invest in a company. So the stockbrokers provide the service as the facilitator for the investor to invest in the listed companies, as well as they provide them information, research, and the knowledge about what is happening in the market. So they keep the investors informed of what's happening. So they provide a service for that. So the investors also, then they get the more information. They can ask whatever characteristics they need about particular investment, particular company. So it's a marriage where both parties benefits and they get the best out of it.
Today, in Coffee with Dan, we are joined by Shehal Bartholomeus. He is a chartered financial analyst and he's the Chief Operating Officer and Head of Research of LOLC Capital One and LOLC Securities. Now we go for a break, and when we come back, let us discuss more on Sri Lanka Stock Exchange and the other important areas that they are involved with. And today we are discussing on a very interesting topic, the stock exchange and the stock market. Turning back to our discussion, Shehal, what are the benefits in investing in share market?
For an investor, there's two way of getting the return that investor get from investing in investments. So share, one is capital gains, where you invest in something. Let's say you buy a land, one day purchase 100,000, after 3-4 years it becomes 150,000, etc. Or in way of if you put a money in a fixed deposit, you get a fixed interest, 10% interest rate. It's a fixed inflow for a particular investment. And when you invest in share market, where you get this, basically it's again it's not a guaranteed return, unlike a bank's fixed deposit kind of investment. But you get a return because the shares are traded in stock exchange. It's a marketplace. It's a common marketplace where buyers and sellers trade the company. So there's a value for the company. And when a company performs better, when a company start to grow, when a company start to show good profits, and it continues in the industry starts to grow, company's valuation starts to pick up. And an investor, because when the investor bought the company at an earlier stage, will see the company's value is going up and the price starts to reflect on the value. So let's say if you buy a company at 100 rupees, and 1 year down the line it starts to reflect the price like 120 rupees. So there's a capital gain. So you can sell the share at 120, then you can get that kind of a 20% kind of a return. That's one way of getting return from the share market. Other way is, of course, the companies declare dividends. Now companies, when they make profit, some of the companies they pay out the dividend for the shareholders. Some companies, they do not pay a dividend. That does not make it a bad thing, but they might have further expansion plans for that extra profit they make. So but that will be reflected in the stock market through the value appreciation. Because investors, there's a wide range of investors. They see value of the company and they price the company accordingly. So mainly when you invest in the share market, you get a return in way of capital gain and in way of dividend. And historically, through various studies, if you even not even limited to Sri Lanka, if you even look at other countries worldwide, you see share markets have outperformed in terms of return compared to traditional fixed income instruments. Like let's say if a fixed deposit is giving you a 10% kind of a return, share market would give you like 15 to 20% kind of a return annualized. But it's a holding period might be different. For a fixed income asset like a deposit, you probably invest in like 1 year, 2 year kind of a period. But share market prices can go up as well as come down because depending on the sentiment. But in the long run, valuation can go up. Now let's say if you buy today, it does not guarantee if you buy share today 100, tomorrow you will get 105 or something. It might come down to your 98 like that. But in the long run, when the company's valuation comes, it's again like a marketplace. You can really tell what's the perception of the investors. But the value of the company goes up, then the marketplace adjusts accordingly. And the buyers and sellers put a price for that. Then you start to realize your capital gain. So in the long run, it gives you very good capital gain. And again, I think across the world, it has shown equity or investing in shares give a much higher return than investing in fixed income like deposit. And even most of the time, it bypasses the returns of the real estate asset. Only buying a land return is also by the share market.
In deciding to invest in the share market, how do you select good shares to invest?
There's various ways of selecting a company. So it depends on the investor's risk appetite and how the investor perceive about the company. And it again all boils down to the potential of the price going up. So when you say you are buying a company, what we need to buy is a company which price has not yet reflected its true value, what we call. Now let's say for example, you get a good dairy manufacturing company. So you see there's a potential people, Sri Lanka's per capita income is growing and people's consumption is picking up. But the share price probably has been stagnant for last couple of years. The valuation of the company as a whole has picked up because of the industry growth and the company's management has put its expertise and all assets has gone up, but the pricing mechanism has not yet reflected the value. So when you invest in a company, you always look for companies where pricing has not reflected the true value. So that's where firms like stockbroking houses, research teams help the investors to understand and realize such opportunities in the market. So let's say if you invest in a company where price has not reflected and you are buying a company that's very cheap, it's like again coming back to a land kind of thing where probably a perch of land worth 500,000, you are buying at around 300,000. But someday in the future the real price will come into play. The buyer would come in at a real price. So then you will realize good capital gain. Similarly to the share market, you buy in a company which has been under valued, so you buy the allocate some of your investments into that, and through 6 months, 1 year, or the kind of a time horizon, it price start to reflect the true value of the company. Then you realize that price appreciation, and then you can realize your gain in that investment.
Investing in the share market always depends on the economic climax.
Correct.
So, how do we know the best time to invest in the share market?
There's no exact rule of how determining what's the best time to invest in a share market. There's different schools of thoughts in that also, Dan. Now some experts say that invest in the market is to when the things are bad, when things are really going down, there you get bargain pricing for the shares. Because when the investors are turning back on the shares, when the investors are staying out of stock market, then you see companies which are probably valued at 150 rupees per share, probably trading at 100 rupees per share. Then you see the attractive. So at that time you attract those bargain shares. But when the economy is doing well, sometimes there can be hype and people are coming back and buying together, and that can push the price up. And but then in the again you might be buying a company which has overpriced. Like your true value might be 100 rupees, but your price might be 120. So there's no correct way of determining what's the exact good time to come into the market. But it's more or less individual's allocation of capital to the risky asset. The share, we call it risky asset. The shares, real estate, land, buying land, gold, we call this risky asset in the sense it does not give you a guaranteed return. So for an investor, you should determine how much of a investment you should allocate to this risky asset, and then you determine what's a good investment to make. So there might not be really a good time to enter to market like that kind of a discussion. But if let's say in 2009 when our civil conflict ended in the country, then it's a good time because most of the prices shares are undervalued, and you can really come in and make a good return. So those kind of exceptional scenarios can come where investors can make a good benefit and coming in and buying. But in general circumstances where the economy is going as usual, then you might know what kind of allocation you need to make, and then you determine how you invest in the individual company. So coming back to your question, on the economic side, it's good when the economy is picking up, but it's the perfect scenario would be when the economy is picking up, the shares prices have not gone up as such. Then you have a good capital appreciation scenario. But even if the economy is stagnant at the same level, hovering on same level, but still you might see good investment opportunities in the market.
All right. So we go back for a break, and today we have with us in Coffee with Dan, Mr. Shehal Bartholomeus, a chartered financial analyst. He is the Chief Operating Officer and Head of Research, LOSC Capital One and LOSC Securities. Well, Shehal, getting back to our discussion, now I saw in the news recently your company winning an award called Global Banking and Finance Review for the best stockbroking research house in Sri Lanka. Now, considering this type of research you're involved with, what is the role of equity research?
Yeah, Dan. So as I was saying, now for an investor to invest in a company, he needs to understand what the company is about. There are 294 companies listed in Colombo Stock Exchange. So how can an investor make an informed decision looking at the companies. There are wide range of vagaries in the market. Like you can be economical reasons, it can be industry reasons, it can be management, various things when you are determining what's a good company and how a company is going to perform and how the company is priced, at what price the companies can buy. So a research firm it does this research for the investors, and it gives you what's the good valuation for an investor to buy a share. So equity research team, they plays a pivotal role in determining what are the good investments for an investor to invest in. So they help the investors on understanding economical dynamics, industry vagaries, all those things. They help the investor to understand by supplying thorough research and in-depth research of those parameters. So then the investor can make much more informed decision and make the much better return on his investments.
We have seen that the stock market has been experiencing upward as well as downward trends.
Yeah.
And some people suggest that when a particular stock market is on a downward stream,
Yes.
it determines the economic downfall of a country. But my question is, does the stock market really determines the economic well-being of a country?
Yeah, it comes to the question of how mature the stock market is. Now, let's say if you take a country like developed countries, like let's say it's a Tokyo exchange or New York exchange, where it's a more matured, more there are so many thousands of companies listed, the investability is billions of dollars. So then the investor sentiment directly reflects the economical sentiment. But in Sri Lanka's total stock exchange market capitalization is only about $20 billion, compared to our GDP of about $81 billion. So it does not necessarily reflect 100% on how the economy performs, but it can reflect to a certain extent. Now, let's say if when the civil conflict ended, Sri Lanka shows rapid GDP growth, and stock market also reacted similarly. And when the economy slows down last couple of years, the stock market has also been slowed down to a certain extent. But it may not reflect directly as compared to developed markets, where it's a direct correlation between how the economy performs and the stock market. So in markets like Sri Lanka, sometimes the economy might be doing well, but stock market might lagging at the same stage. Or vice versa. Other side doors stock market can pick up rapidly to some unknown reasons, but economy might be at the same level. But as a rule of thumb, generally those two goes in hand. When the economy goes, and the stock market also generally picks up.
My final question to you, Shehal, is we know that the stock market generates a steady income for an individual. But is this a good time to invest?
Yeah, when you determine good time, as I was saying, then it's all about the valuations. Now, in Sri Lanka, how we need to determine the valuation is there are some parameters like how much price you are paying for the profit you are making, how much price you are paying for the net assets of a company. So, as a whole, our market currently it's undervalued. So, it's the price appreciation potential is higher. And why we are saying this is we are comparing it with the region. We are comparing with countries like Pakistan, India, and ASEAN countries, Thailand, Malaysia. And compared to those countries, our stock market is undervalued. So there's more potential to come. And you can see this year foreigners have been coming at a very aggressive rate. One of the highest foreign inflow to date in Sri Lanka. About 30 billion rupees has come in just for the extraordinary items. So you can see foreigners see value. So it's kind of a good time now in the market for local, but still the locals have not come in much in the market in this year so far. But I think now it's a good time for locals to also to come in and realize these investment opportunities. And generally, when the foreigners come in, they do thorough research and thorough understanding of the countries they are invested in. So that gives a kind of an indication for the locals to have that added confidence that this might be a good time to invest. So probably I think this might be a good time to invest in the market.
Thank you very much, Shehal. Today in Coffee with Dan, we had Shehal Bartholomeus, a chartered financial analyst, and he's the Chief Operating Officer and Head of Research of LOSC Capital One and LOSC Securities. Thank you very much, Shehal, for joining.
Thank you very much, Dan. Thank you for the opportunity. Greatly appreciate. Thank you.
So again, we will have the Coffee with Dan on Friday. We are discussing about another very interesting area, the Hambantota Port Development.